from New York, I'm Vonnie Quinn, and this is Bloomberg Markets. Time for Futures in Focus now. Excited to be joined by Bill Baruch of Blue Line Futures. So, Bill, will we see a repetition this month of what happened with the oil contract last month?
You know, it doesn't seem like we're going to see a repeat from last month, but there are still demand worries. And the IEA echoed those this morning, but at the same time, they echoed a more watered-down outlook in a better way, watering down the grimmest of fears. But ultimately, there still is a demand worry going over the next 30 to 60 days. But the market itself has reacted very well. I mean, we've seen the crude oil rally across the complex, across the energy complex. We've seen gasoline has today recover too, with demand expected to come back online as economies in the U.S. and across the world start to ease lockdown restrictions.
What are you making of demand projections, Bill? Because we're getting different ones every day. OPEC has now reduced by 3 million barrels a day its demand projection, and at the same time, Russia and Saudi Arabia seem to be sort of mixing their messages.
I think that the price action at these levels has priced in a perfect cut across the board. It's pricing in what OPEC's saying they're going to do and have done, and it's pricing in the about 1.4 million barrel per day estimated drop in U.S. production. So I think really the elephant in the room becomes, do we see wells in the U.S. come back online? As the market, if you look down the curve here, I mean, you're seeing December crude oil above $30. And, you know, I think at that point, it gives operators an opportunity to hedge. And we could see U.S. production start to come back online over the next 30 to 60 days. So that, I think, could be the fear. I think against $30 here, or just below $30 in the front month contract, there's very limited value. I do expect one more wave down. However, I do think that wave lower is going to be more shallow than I had anticipated, say, 30 days ago.
Bill, what is the equity market waiting for next, and which direction, you know, does it head? I mean, if it's the China narrative that continues to play, we're not looking at, you know, anything very positive there. If it's jobless claims and the economy, we're not looking at anything very positive there. If it's DC and a new stimulus bill, well, you know, there's not much hope for that at this very moment either. So why is the equity market still going up?
Well, the equity market, I mean, is pricing in the massive stimulus that was seen, whether it be fiscal or monetary, and that's being digested right now. However, as well, it was pricing in the fact that the economies are going to open, and how smoothly those easing of lockdown restrictions play out are going to waffle this market back and forth. But the reality is, the market overshot to the downside quickly, and it overshot to the upside. I think we're seeing the equity market settle in a bit here, and that's important. It needs to find its fair value. I think there's across the board, there's going to be uncertainties that are going to linger out there. We're going to see, I think, a new low in Treasury yields. I think the safe havens such as gold and the dollar are going to see value. I think that is how we're positioning. And then the U.S. and China trade. I mean, there's a new chapter here. Jobless claims today were definitely a point, but I think it was President Trump who made a comment aimed towards anger with President Xi this morning is why the equity markets sold off more sharply. And tonight we get a deluge of data from China, industrial production, fixed asset investment, retail sales. All of that's going to play in. So, you know, it's going to be an interesting market here.
Yeah, and we're actually seeing those losses get pared back now. The Dow is only down about 0.2%. Our thanks to Bill Baruch of Blue Line Futures. It is